सब सुनेगा।
नहीं सब सुनेगा, इसीलिए सुनेगा, लास्ट डे है,
होएगा, ये पढ़ लेंगे.
So I think nobody has any issues with what is debt.
Yep.
Right? I assume that everybody understands it. It's basically a contractual commitment. Usually it is tax deductible, and failure in payment.
Guys, rest of it can everyone else mute? Yes, Suresh bhai, please continue.
Yeah. So we all are aware that it's basically a contractual commitment, and commitment is usually, that interest part is tax deductible. Whereas failure will lead to part or full, may lead to losses in businesses. So what is the cost of debt? Debt is basically the rate at which you borrow money, and it's yield on the bond earlier issued will give a fair picture about it. Then how do they use? They use synthetic ratings by with the help of interest coverage ratio, a bit divided by interest expenses, or average of last 3 years, estimated expected rating, size of the company, and the cost of debt is equal to a risk-free interest rate plus spread plus the country default spread. This is a basic formula. I think it's only a conceptual kind of a thing. Then debt financing. Basically, why do we go for debt financing? Just to share, usually to share, avoid shareholder dilution or loss of control. Number one. Number two is we can get it fast, or it can be arranged fast, and can be repaid or restructured easily. Likely to require less reporting and interference in management decision making. Interest payments reduce the corporate tax liability, especially the risk of default on loans, and the repayment schedule. Right, and it can also lead to reduced cash flow for reinvestment, interest coverage, EBIT, and interest. These are the issues which are to be taken into consideration: covenants, interest cover, and debt service cover. Right, equity financing we generally go for. In case of equity, it's basically 1 minute. It's theoretically it is an unlimited source of funding for any business and no obligation to repay.
ये मैं थोड़ा बोलूं quickly मैं
yeah
करूं.
Okay. Yeah.
In the
yes,
in the debt, what Suresh mentioned was that what is important is what is the interest. How do you find out that what is the rating? Basically, debt service cover is important, and the debt service cover is nothing but the operating profit or the EBIT divided by the total debt plus is payable. So basically, what is the capacity of the company to pay the debts? And in equity financing, he's saying that theoretically it is unlimited financing, but it is not true. It is your different class. You have
this is theoretically. Practically, it may be totally different.
Yes. So practically,
but theoretically, yes.
Equity financing, we all know about it. Yeah. And basically, he's saying that the advantages of equity are obligation to repay capital is not there. You don't have you have different classes of equity, which is preferential and everything which is good. Dividends and liquidation is possible. Important to attract new capital. And
start these are the major
equity round. So it is telling you what are the different rounds of equity. It is pre-money valuation, issue price per share, number of shares to be issued. So pre-money valuation is basically before the purchase equity investment is happening, what is the valuation of your company? So if it is 2 million, if you are taking an investment of 1 million, and after the number of shares that you will issue to him, put together with your shares, whatever is the share per value which you will have taken at the time of valuation will be your post valuation figure. And so why would a company need PE? So he's saying that the company needs PE not only because of raising funds, but also because it has a certification benefit. Because if a well-known PE is putting in it, it automatically gives a credit to your business. There is a network benefit because a PE will get a lot of network benefit, knowledge benefit, and financial benefit. This question can come that what are the benefits that the PE will get? Certification benefit, network benefit, knowledge benefit, financial benefit. These are the 4 benefits that we have to remember.
Falguni, remind me what was certification benefit? I probably forgot that.
Certification benefit is, that say suppose if I'm doing a business in a food company and
Remember. Yeah, got it.
it kind of gives me an accreditation that this
I
company
can
is
take
worth
funding from
investing.
somebody. Yeah.
It gives me credit.
No, I
If
think
a leading private equity investor is investing into a company,
correct.
it is like a certificate that it is.
I think it's
because
So Suresh, it's a basically when the recognized PE is when you are backed up with that, right? So that is the confidence level on that business that this XYZ
accreditation
company.
yes,
Exactly.
yes.
So that is the certification is meant over here.
Means you kind of get it's not like an actual certificate, but like a certification benefit that you get accreditation that okay, this is a worth business. Right now also that Ashleen Grover or whoever that is, he's putting money wherever, then everybody is rushing there thinking it is a big opportunity. Okay, what is capital structure? The combination of debt and equity. Sorry? Somebody said something?
No, somebody
No,
can't.
continue.
Go on.
So what is a capital structure? Basically is a combination of debt and equity which is required to finance your business is called a capital structure. So the combination of both two which is used is called your capital structure. Financial leverage and risk. So what he's saying that the equity owners can do financial leverage. How can they do financial leverage? By whether they should take debt or they should take more of equity. So that was, he was saying theory proposition 1, where the value of leverage. So what is theory proposition 1 saying? The value of your leveraged is equal to your unleveraged firm. Both the assumptions are same that because the tax will be 0. Then in proposition 2, where no taxes are there, actually, you know what this theory proposition 1 and theory proposition 2, both are theory only. So the cost of equity rises with leverage because the risk of equity rises with leverage. So what it's trying to say is that in this case, even if there is no taxes, if you are taking debt or not taking debt will give difference to the leverage of your equity shareholder. So there is certain kind of a premium given to the equity shareholder because he has to pay the interest, the cost of debt. So there is certain kind of a beta kind of a thing in this. If somebody can explain this formula, it will be good.
Yeah, it's a cost of capital, I think, plus the debt to equity ratio. Then you have again cost of capital minus, I think, the interest, if I'm not wrong.
Yeah. So formula is something where
last wala.
See,
last one.
The risk of the so-called leverage firms is equal to unleveraged firm plus the debt equity ratio into the the so-called rate of O is basically rate of equity part plus minus debt car. It's anyway that is basically this formula is not of much of a use. And
R0 is cost of debt and RS is the cost of equity.
Yes.
The difference rate in the rate difference.
Yeah.
Yes.
See what it is saying. I'll tell you what this says is the first preposition says that there is no difference if there is no tax because when debt is only beneficial when you have taxation in your company. But so proposition 1 says that there is leverage and unleveraged firms are same. The value is same. But the proposition 2 says that no, when you take debt, there is a leverage which increases your risk and return both to the stockholders.
The first proposition says that in the taxes are immaterial, so the firm value will increase with leverage.
The value of leveraged and unleveraged firm is the same under the assumption that there are no taxes.
The value remains the same because there are no
Remains
taxes
the
at
same,
all.
Ketki.
Yeah.
No, the okay. The
क्योंकि ना
PPT
मैंने
was
इसका सिर्फ notes पढ़ा है. I have not seen the recording.
in case of the second one, the assumption is that the risk generally of equity is higher than that of debt. That is the reason why the cost of equity keeps increasing. So in the previous one, the cost of equity and also debt are the same. So irrespective whether you go for leveraging or unleveraged, it will be the same.
So if so, maybe let me just ask question here. So let's say we are in high corporate tax scenario, right? So in that scenario, we can have this kind of question, right? Which is better or optimal
Leverage.
structure?
Leveraging is
Whether
better.
the leverage is
Debt,
better.
debt.
Yeah. So
Debt. Yeah.
okay, got it.
Now, proposition 1 and 2 with taxes. So with taxes, everybody knows that with corporate tax, firm value is increasing with leverage. Leverage means what? Debt. When you're taking debt on yourself, the firm value will increase. Why it will increase? Because the professor had shown that EBITDA, when you are doing operating profits, out of that, the interest is also reduced and then tax is applied. So if you're paying, say, 30 lakh tax, but now your interest is 20 lakhs and on that there is a tax of 10 lakh rupees, then you're paying only 20 lakh tax. So you're, in effect, you are net of interest minus the tax saving, whatever is your EBITDA profit that's increasing. So you are having, if you are better off if you are taking interest loan on interest. So proposition 1 with corporate taxes, firm value increases with leverage. So VL is value of leverage firm is equal to value of unleveraged firm plus the tax benefit. The T is the tax benefit. The tax cash benefit, TCB. Now proposition 2 with corporate taxes. Now there are two propositions. I have not seen the video of the professor, but while reading the notes, I was wondering what is the proposition 2 also every time that he's giving. So some of the increase in equity risk and return is offset by the interest tax sheet. So he's saying that there is an increase in the equity risk and return because we are leveraging, we are taking outside debt. So there is a assumption in the second proposition that the equity shareholders risk is increasing. So this increase in risk is offset by the interest tax sheet. So RB is the interest rate. So in the second proposition also, you will finally be benefited, but it will be net of your increase in the equity risk also. You have to reduce that part. Financial leverage and risk. Can you go down?
Yeah.
So equity
So
owners
just a minute on the formula. Just one simple
you want to see
point.
the formula?
Yeah, just 1 minute for everyone's I think
Yes.
understanding.
So what we are saying, the formula, the formula is saying that return on equity is equal to the return on unlevered liquidity. Equity means the one which is not having the cost of capital plus whatever debt you have taken divided by equity, value of levered equity into return of unlevered equity minus interest rate, the cost of the debt.
Yeah. Okay.
ये फॉर्मूला आएगा क्या?
Formula it is not so difficult at all.
अभी वो कुछ illustration देके करेगा तो पता नहीं है मुझे तो अभी.
नहीं, it can come also. It's not very difficult as such.
No, it's not
Which
difficult.
formula is not
It's
difficult?
not
Remembering the formula is difficult.
even that we should not have any issue. See,
Professor told
here
that formula is required, so they will be providing the formula after the paper in the question, I think.
Yeah, that we need not worry
I
about.
think इसका concept थोड़ा
basically plain English में it just says that the return on equity is basically your return in the absence of taxes minus taxes. So the total return that you will get will have to be offset by the taxes.
So just a question. Since we are looking at the formula, if your cost of equity, suppose say the return on equity is 5%, okay, just an example, and then
Right.
your cost to serve the debt or the RB part, which is the interest on the debt, is basically 7%. Will that
नहीं,
give
वो
the
नहीं हो
negative
सकता.
number?
वो नहीं हो
Actually,
सकता.
it's vice versa,
See,
because cost of equity is always higher than the cost of debt, because you are not having,
Naturally.
you are taking the risk. So the example which the professor has given, he has considered 10% as the cost of equity and 8% as the cost of debt. So if you go by
उल्टा नहीं हो
that,
सकता.
then the cost of equity will always be higher than the cost of debt.
अरे
Okay,
नहीं है
okay.
तो अच्छा, why will anybody take risk यार? उससे अच्छा है बैंक में लगाओ, पैसा
Yeah.
लगाओ, क्या करने का?
This
It's
formula is
basically a logic,
basically,
boss.
yeah. So this formula is basically to arrive at the weighted average cost of the capital.
नहीं, weighted average से भी क्या है ना? See, let us understand one thing. What does the first अरे अभी दिखाई दे रहा है कुछ? मुझे तो कुछ भी नहीं दिखाई दे रहा है.
No.
Blackout.
Only R0.
Black screen.
I'll just come back again.
By the time you share, Aditya, we are seeing you very different now. हमेशा शर्ट कोट में रहते हो, इन टी
मैं अभी
शर्ट
casual हो गया.
कैजुअल हो गया.
Can I share my screen, because I have done that calculation in Excel?
Yeah, of course.
Yes, Manish.
Okay.
निकी और पूछ जल्दी शेयर कर दो.
नहीं, इसमें कुछ नहीं है. See, what does it say? What is the first proposition say? कि the value of unleveraged firm is equal to leveraged firm. So इसमें third वाला, second वाला proposition में यही बोलता है, ये दोनों नहीं है. In fact, because this particular equity happen to be a little more riskier, you generate more the so-called returns. You know, वो returns कितना आएगा? It all depends on the debt equity ratio plus the difference between the interest rate, or rather the cost of debt and cost of equity. That's all. कुछ नहीं है.
अभी कोई शेयर कर रहा है क्या?
Manish said he is.
Manish said he will.
सुरेश भाई,
Otherwise,
सुरेश भाई आप ये बोलते हो ना कि इसमें कुछ नहीं है,
Are
इजी
you
है,
able to see the screen?
तो हमारा कॉन्फिडेंस और लूज हो जाता है.
अरे simple logic है गुरु.
Are you able to see the screen?
Yes, we can.
Suresh is considering from his side.
Yeah, Manish, go ahead.
It's not for people like वो immortal का बात होता है.
I think somebody else is sharing the screen. That's why my screen is not there.
No, you
No,
are
Manish,
present.
we can see you.
See the Excel
See your
sheet.
screen.
Okay, so this is the formula. Basically, if you see this, the proposed structure and the current structure. So the current structure what he was given was before taking any loan. So we should see these two propositions. Proposed structure where we have taken that the cost of equity will increase when the company is taking a debt. So the cost of debt, it's a 8%, and in the given formula where the value of the leverage firm or unleveraged firm is equal, in that formula, WACC, if you see, it will remain 10% in both the cases, whether the firm has availed the loan or not. To illustrate it, he has shown that the cost of equity will increase from 10% to 11.33% in case if you are taking a loan and the debt equity ratio was 60 to 40. And formula which was given was RS is equal to 10%, which was the cost of equity. Then the debt equity ratio 8,000 to 12,000 multiplied by the 10% minus 8%. So 10% is cost of equity and 8% is the cost of debt. So the formula, if you calculate the formula, the weighted cost, the cost of equity will be 11.33% and cost of debt was 8%. So weighted average cost will be 10%. It will remain to be 10%. Now
This is without taxes.
So it will be always above the cost of serving, right? Whether equity or debt.
Yeah, but cost of equity will always remain higher in comparison to cost of debt, because equity, the providers are taking the risk on the company basically. Now in the second scenario, if you have the tax component, so formula remains the same. Only thing which is changed is multiplied by 1 minus 30%. So 30% was the tax rate which he was considering.
So it is revised cost of equity eventually to cover up the additional cost that you would incur on debt.
Right. So here the equity, the cost of equity will be slightly on the lower side, and it will be 10.93%. So weighted average cost of the firm will be 9.8% in comparison to 10% which was earlier there. So that was the thing which he was given, and he illustrated it with this thing that suppose firm is having 1,000 rupees revenue and 500 as a cost, then EBIT is 500. Then interest in the second case is, say, if you are paying 100 rupees interest and taxes is 150 and 120, so here you are getting the benefit of tax. So accordingly, the weighted average cost of tax capital will reduce. So this was the formula basically.
So what is that 1 minus 30%?
It's tax rate.
So it's tax.
30% is the tax rate, yeah.
Sure.
Right.
And how you come to know the cost of equity 11.33?
It was assumed to be 10% in case if you have not taken any loan. So the cost of equity which was assumed to be, it was 10%. And when you have taken the loan, so he has calculated that how the cost of equity is going to be calculated. So for that, he has given the formula which was RS, where R0 plus debt oblique equity. So this was the formula basically.
Got it.
Great, yeah, thank you for getting this here.
Yeah.
Manish, thank you so much.
Welcome.
Who is sharing now?
I'm going to share.
So equity owners can reap most of the rewards through financial leverage when their firm does well. This one may come that equity owners when can equity owners reap the most of the benefit and rewards?
When the firm is doing well, then equity owners are going to benefit. If the firm is not doing good, so they are going to lose.
Yeah, and the optimal capital structure is the mix of debt and equity that maximizes the value of the firm. And while we cannot specify a firm's optimal capital structure, we do not know the factors that affect the optimum. But there are different industries would have different capital structure. The greater the marginal tax rate, the greater the benefit from the interest deductible. And hence, the more likely the firm is to use debt in its capital structure. So what the professor said was the greater the marginal tax rate, the more the company would be using the debt as its capital structure. Because there is a marginal tax rate is high, so interest deductibility would be provided.
I think we can move further.
Yeah.
So professor, hi, one thing. So professor mentioned basically three factors are there which affects the optimal debt level, which as one is the different tax rates, another one is the level of business risk involved in the industry, and third one was basically the dependence on the intangible. Because if the company is having the high intangible, in those cases no collaterals are there generally, and accordingly the debt cost to them is generally higher to those kind of industry.
Absolutely.
No, the greater the extent and value of the firm depends on intangible assets, so less likely.
That is already covered.
So they are saying
next
that
is
in that case they will use more of equity because they'll not get debt.
Right.
So this is the favorite topic of.
Are we in global economy?
Can I, Suresh bhai, can I ask a question over here?
Yeah. Carry on.
My question is that this intangible assets. So typically, I think the example would be IT industry. There might be a lot of
patents.
Yeah, there might be a lot of people from the IT industry or these kind of industries. Can they just give a sense of what exactly would be the debt levels compared to, let's say, conventional industries like manufacturing and all?
See,
so what exactly is the point? How do these firms, firms having high intangible assets, how do they actually use leverage?
See, in case of knowledge industries, whether it is IT or any other KPO or anything, what is the resource which they use? Generally, it's all
कोलेट्रल तो है
used.
नहीं, कोलेट्रल नहीं कर
all
सकते हैं,
So,
तो
Suresh,
इक्विटी
can I
होगा.
come in here? Uday
I'm
here.
sorry. Yeah.
See,
Yeah.
our industry, for example, we run a very asset-light model. We are in healthcare. We don't own any assets at all except the medical equipments. We are into ophthalmology business. So the only asset that we keep as collateral is our shares. So we have not found it to be our interest rates to be higher. We still at 7.75, 7.5%. So it all depends on how what our credit worthiness in terms of how our EBITDA to free cash flow is and the pedigree of the promoters, etc.
So the other benefit that IT industries have is they can go for much lower interest rate loans because they earn foreign exchange, right? So there are FCTL loans that are available, which are like, so if I go for euro, it is LIBOR minus 0.5 minus 1%, right? So it will be in the
लाइबोर प्लस है ना कल्पेंद्र, माइनस किधर?
माइनस, यूरो में माइनस है.
अच्छा, यूरो में
-1.
और भी माइनस है.
हाँ, और डॉलर में आई थिंक इट इज लाइबर प्लस 2 या 2.5 है. So the range is anything between 3 to 5%. So that's the only leverage that IT industries earn. Otherwise, the ratio will be in the range of not more than 10%.
See, I think the other thing which actually determines the cost of debt and how much debt you should leverage is the EBITDA coverage, right? Interest coverage. So the better the coverage is and the consistency, also. So I think you're in a better position to kind of go for debt. At least in our company, we have seen that our coverage is very good and it has been very consistent across through last couple of years. So that has, even though our debt ratio is higher, but it's operationally quite fitting into the PNL and it's really working fine.
Okay. Okay, great. Thank you. Thank you for the examples. Helps.
Yeah. So this is one of the most, you can say, interesting topic, global economy. See, what do government do when it comes to macroeconomics? Like they basically do the regulation of markets, fill in missing markets wherever the private players can't do. This is where the governments come into picture, especially like spending into infrastructure, public goods, and social goods, etc. Then play counter-cyclical policies, like with the help of the so-called fiscal and monetary policies, and play a role in getting rid of structural constraints. So, like ease of doing business, all those stuff, so that to encourage more people, private players investing into the country or their economy. Then there is one concept. See, actually, I just put only those things which I felt it is important with respect to examination. Rest all is like for our general understanding and general knowledge. So the sovereign bank risk nexus. This is what I felt it to be a little more. This may come up in some form or the other. Like it's basically a nexus between the sovereign and the bank. That could lead to self-reinforcing adverse loop that ultimately could force the government to default. Like that is also known as a doom loop. It happened many times in Russia in 1998, Argentina, even the recent Sri Lankan crisis also can be a kind of a this. What is a doom loop? This I have basically took it out from some reading from internet. So I think this is self-explanatory if you can read it. So I'll be reading it so that people can understand what exactly it is. A doom loop describes a situation in which one negative action or factor triggers another, which in turn triggers another negative action or causes first negative factor to worsen. Continuing the cycle, it is equivalent to vicious cycle in which a downward trend becomes self-reinforcing. If a country experiences a debt crisis, the value of the sovereign debt government bonds may fall. And as domestic banks usually own government bonds, the value of their portfolios will also fall, possibly so much so that they need government help to stay solvent. The heavy government spending to bail out the banks hurt government's credit rating further, which forces it to raise interest rate to attract buyers for its sovereign debt. Higher interest rates also slow the economy, which means less tax revenues, which the government relies on to pay for, among other things, the bank bailout. The government may need to borrow even more to cover the lost tax revenue, further hurting its creditworthiness and dampening the economic growth even more, which in turn causes tax revenue to decline further. Declining value of banks' bond portfolios may also mean that they have less liquidity and can lend less, which also dampens the economy. If a government's credit rating falls below investment grade, many investors may have to sell its bonds, including banks whose guidelines often say that they cannot own non-investment grade bonds. And the loop increases borrowing pressure on the already stressed government, which further reduces the value of the bond it issues, and the loop continues. It's like a vicious circle. So this is in a nutshell about doom loop. So if you can go through, I think it's the moment you find within that the options, I think you can easily identify it. Now, what are the kind of policies? In macroeconomics, there are two kind of policies. One is fiscal policy, where generally deal with tax rate, subsidy or income transfer. Then your public borrowings and disinvestment. These are the four areas in which fiscal policy usually deal with. And then there is a monetary policy. That in monetary policy, policy rate, repo rate, Fed fund rate, or quantitative easing, expansion of central bank balance sheet. Then your directed credit programs. Basically, they will give some loans, like housing or agriculture at a cheaper or subsidized prices, subsidized interest rates. And then the credit guarantees, in which the guarantee which is given by the government of India when it comes to SMEs, they fall under credit guarantees and cash reserve ratio. These are the areas in which monetary policy usually deal with. And what are the key differences? This may come up like these are the two which I felt may be a little useful in this particular session. That is, what are the key differences between monetary and fiscal policy? Fiscal policy is a direct. It's like putting either money into the relevant sector. Monetary policy is indirect because you are only trying to control the liquidity rather than infusing anything. So an expansionary monetary policy reduces interest rate, thereby incentives investment. That's in any case. The vice versa is it's also true. Like if it increases the interest rates, it disincentivizes investment. An expansionary fiscal policy lead to direct money transfer and hence may increase the interest rate as long as it is sufficiently above zero. But both have the potential of increasing inflation. That's it. So, which may usually happen during a recession.
I have a question. Sorry, Suresh bhai. I have a question over here. Why has the professor mentioned in his note that inflation might not be a bad thing during a recession? Because
It's a
if you've
natural
seen the
remedy, basically. It's
what's the explanation why it might not be a bad thing during a recession?
it's
High inflation.
So what happens is higher inflation basically means more money running behind goods, which indicates that the demand is much higher. And how to come out of recession is when the demand is more and investments are happening for capacity buildup. So that is how we come out of recession. So hence, an inflationary scenario during a recession means that it will trigger more investments.
Inflation is also good in the sense.
But why during a recession demand would be high? Why would demand be high during a recession?
No,
No,
demand
actually,
will not be high, but
yeah,
inflation means for every 100 rupees you are having actually 110 rupees.
Absolutely.
Right?
Okay.
So when you have more money and when multiple people have more money, the demand, you are ready to pay more for that particular good. Hence, whosoever is supposed to invest sees an opportunity there.
See, the question here is like, would you like to invest when you are getting when the prices are falling or prices are increasing? Simple question. Naturally, when the prices are increasing, that is the area time when you tend to. Rather, it all depends on how much it is falling and how much it is rising. So generally, it encourages because the cash flows increase for a company, and say if they had already, that entire the so-called inventory cycle, it keeps going much before the inflation starts. But again, it may take a hit, but it takes time. So till then, it will be advantageous to the firms, and later they will adopt to some other means whereby they try to use that derivatives and all those kind of things or hedging, all those strategies to ensure that they pay less or their whatever the price hike or price increase is taken care of. Aditya Bhai.
so maybe let me try to
No, I think
answer.
I think it's still a little bit
Yeah, so let me try
confusing.
to, yeah. Sorry, someone is saying.
Because it depends upon if your economy is growing, that means the inflation will, whatever the inflation is there or recession is there, the growing economy will not stop, right? And if you go to UK or any other places where the inflations are high, people are like crazily downgraded their growth prospect for future years. So if you look at that area, then inflation is not good for their economy particularly.
Time schedule.
So it
So,
depends.
Aditya.
It's not a straight answer.
Yeah, so Aditya, is that your question is why interest rate? I think if I understood correctly, how interest rate is basically mitigating your recession, right? Is that what you are trying to understand? Just correct me if I'm wrong.
No, I'm not interpreting anything. I'm just wondering why it was mentioned in the note, by the professor that by Partha Ray, that inflation is not a bad thing during a recession. So I just wanted to
Yeah.
comprehend that
Okay.
statement. So
Yeah. Okay.
yeah.
Okay. Understood. So basically, during recession, right? So then naturally, if you look at, there are three things happens. Very very high level at a macroeconomic level. Your unemployment rises, right? Then the prices sometimes they fall again. That entire process, if I remember correctly, it's called again deflation, right? Now to help to accomplish your situation during recession, the Fed basically, the government, they employs various different monetary policies, right? That is to basically suppress your unemployment rates and reinflate the prices. That is the first thing. Then again in to regulate your reserve regulation, right? Again, the discount lending, your forward guidance to manage the market expectation. All these are different tools which are your government is making sure to adjust. And that's why always people say that, what is your high inflationary situation is basically when your interest rates is coming up, it's rising.
That is
And then
actually
naturally,
addressing,
yeah.
1 second, that's actually addressing what you will do during an inflationary situation in recession. But in a recession, the inflationary tendency is good because people are buying more and you're putting, there is a behavior which is kind of purchasing more. I think from the inflation where it impacts rather than how you control with the measures you take, it is how you actually buy stuff or you create that whole thing and lift up the recession. Recession means everybody is recurring purchases. There is a trough which you're going to hit. When you have to pull the trough up and
bring in an artificial inflation or whatever. So that is the one which I was alluding to as what Dr. mentioned.
Sudhir, sorry, actually, is that me or everyone is because I cannot. I'm not getting what exactly Sudhir is saying. Is that because of my network or?
Basically, inflation boosts the economy.
Yes, it pulls it up out of the trough. Right? You have a cycle, peak, trough, and whatever thing, right? So during recession, it's tending to go down. Sorry, whether you heard it or not, that's what I'm trying to say.
Sudhir, your voice is coming your voice is coming not directly from the mic, somewhere remote.
Okay, I'm at the far end.
Probably there is a lot of background noise from your side.
Okay, I think Suresh bhai, I think probably we can probably deliberate on this. I think in campus because otherwise we'll keep losing time. But yeah, but I think a few points are pretty useful.
So basically, government is making sure that people becomes poorer, right, to control the demand size. That is the bottom line. That's what happens. To make the demand side, you need to control that in order to create an equilibrium into your demand and supply, right? Because your demand is high. Now, when the demand is high, people is basically they want to buy, right? So when you increase your interest rate and other thing, inevitably you are actually making people poor. That is going to reduce your demand. So that is how the people, government is trying to control. That's my understanding is, very high level. But again, we can discuss this in more detail.
चलो भाई शेयर करो सुरेश again please.
Suresh went for glass. Sir, here you go.
Till Suresh is sharing his screen, I'll just share with you all that the Indian economy has two ways to classify the structure of the GDP. One is the consumption plus investment plus government spending plus export minus import, whatever is the net, that is called the GDP. And the second way of classifying a GDP is equal to your GDP of agriculture plus GDP of industry plus GDP of services. This is the two ways of calculating the GDP.
See, you can calculate GDP in terms of consumption and in terms of income. GDP consumption plus investment plus government expenditure, export minus import. This is basically the from the side of consumption, and it will be equal to income. Income can be from three sources. It can be either agriculture, industry, or service. As simple as that, right? So I think people should not have any much confusion about it.
So Aditya bhai, on your the note was there. It says the may not be a bad thing during recession. So it's a may. So it might or it may. So it's a basically just a not a normal case particularly.
So that particular view, because of like few economics things like that. So the view is like few economics think that inflation in the recession time is not always the bad thing, but it does not mean that becomes a fundamental rule that which you always find in a recession times and all. So this is not like all the economists being agree to this particular rule. So I pasted one of the like views from the in Investopedia on the chat box, so it can help.
Yeah.
Suresh,
Can you send that? Can you send? Was that Naveen?
Yeah.
He sent it in the chat box.
Can you send that separately? As a message to me. That will help, Naveen.
Yep, sure.
Thank you so much.
We didn't cover the demand supply curves and all that, right? Don't we expect any questions? We're on the fourth session already.
नहीं वो अभी ये थर्ड है केतकी
ऊपर देखो फोर्थ
लिखा है फोर्थ है
नहीं पर थर्ड सेशन कवर ही नहीं हुआ है अभी तक
नहीं लेकिन ये फर्स्ट सेकंड सेशन में था द डिमांड सप्लाई कर्व्स वर इन द सेकंड सेशन
when it comes
to बाद में आ रहा है ये फोर्थ है 1 2 and 4 है ये
Falguni, in case of third session, the most of that is basically application rather than a concepts. Concepts are very few. Rest all is all about economic data and analysis of it. The macro.
My question is on
Yeah.
the second session itself. We covered
Yeah.
this demand supply curves in which he talked about supply side inflation and all that, and then he'd also spoken about fiscal balance and current account balance and those kind of things. So you don't
Those
expect
all.
anything?
It's basically for our conceptual understanding. I don't think.
Concept पे ये क्या पूछेंगे? This will only be concept, right?
नहीं, that is also a concept. वो कर्व में क्या दिया है? If you can just share it, then we can discuss about it. क्योंकि मैंने क्या किया? I have avoided all the so-called graphs. क्योंकि graph is something. If we keep on, there are so many graphs. उसका हर एक का अलग-अलग interpretation है.
No,
Suresh ने avoid
using the
किया है,
focus.
मतलब we can avoid it.
Okay.
सुरेश बोलते हैं सब कुछ important है.
Ketki, can I recreate these situation here?
Yeah, of course. If you can.
Ketki, I don't understand what your concern is.
No, I thought because he spent like an awful lot of time on this, so something.
Okay, I'll take a stab at this if you don't mind, and you guys can correct.
You always stab it, right? From the back.
you guys can correct me if I'm wrong. So basically, the basic concept is that if you plot, on the y-axis the aggregate price, and on the x-axis the aggregate output, right? If the intersection of the demand and the supply curve. Here, what has happened is that
I got the point.
There's a downward shift in both the demand and supply curve simultaneously because of the war and because of COVID. As a result of that, what has actually happened is that the price has increased and simultaneously the output has decreased. That's essentially what he was getting at. So it's a very unique situation. Generally, it does not happen. Either the price increases or the output increases. But here, because of the onset of COVID and then the aftermath of the Russia-Ukraine war, both the demand and supply curves have shifted downward, and hence the output has decreased, but the price has also increased. That's essentially what he was talking about. Does that help?
I think he also further went to add that this therefore led to something called a supply side inflation. Yeah.
So this is related to the fourth session. In the fourth session, we have discussed about
third session में कुछ नहीं आएगा. We wasted 3 hours.
Wasted 3 hours मतलब देखो वो सब fundamentals are very few. बाकी सब it is all about macroeconomic.
So 3 hours into 100 people minimum.
The foundation but नहीं दिखेगा ना. So foundation will be always there, but without foundation you cannot build.
Yeah.
These two formulae for GDP that Falguni mentioned are there, I think, the second session, third session.
Ketki, you are talking about 3 years. I'm wondering for 4 years in CA.
मेरा तो अच्छा खासा strategy में MBA था. I don't know why I decided to pick up finance now. But...
Okay, guys, let's move ahead.
I think only one thing from that session which is interesting, which is fiscal balance versus the current account balance, which he has presented in a graphic. He has just on a whiteboard he has mentioned it, right? So if you guys can just take a note of that, that will be helpful. That's what I think is important in that.
No, it is all about understanding of the theory, how it works. So उसका basic concept इतना ही है, उसमें तो थोड़ा expand करके सब पे दिखाया था. That in any case you can go through. So if we keep on spending, then we can't spend more than
आपका ही note use कर रहे हैं. There is nothing else. We are using your note only.
Guys, another 6 minutes to crash on the bed.
Yeah, absolutely. So let us continue. So these are the mapping of fund resources. Like it all depends on the x-axis we have taken technology or business model, And then the y-axis, we have taken the capital to reach cash flow positive. Like in this particular matrix, there are four quadrants. Like with low technology and low capital, usually typically in case of small businesses, they go for personal credit or bank loans. So when it comes to low technology or business model novelty, with high capital to reach cash flow positive, that is where the commercial banks and project finance strategic investors come into effect. And then in case of the third quadrant, that is uh, high in technology or business model novelty and low in capital to reach cash flow positive, that is where usually new technologies, where angel investors and venture capital funds will come into existence. And then the fourth is related to high in technology and high in capital to reach cash flow positive. It is basically capital intensive new technologies. They are very hard to find fund unless you have a very deep pockets and a novel idea.
Not non-proven unicorns. That's what.
Yeah, absolutely. And what he says is generally you as a investor or or the so-called promoter of a company, you go generally for loans or debt only in case of capital intensive proven technologies or new technologies. Otherwise, it doesn't increase any value to your company. Rather, uh, you better go with your equity. So this is what he told about the differences between private and public equity. In terms of pricing, public equity, the pricing is driven by the market, either upwards or downwards. It's all totally by the so-called movements of stock markets. Then in case of private, the price is the result of negotiation process. Basically, it is a two-way negotiation between the investor and the promoter. So whichever fits in and where they reach an equilibrium point, that is the time, position where they go into agreement. So then when it comes to liquidity, in case of public companies, it's basically liquidity is very high because whenever an investor want to sell the share of a public company, there is always a buyer, in the stock exchange, unless the company is the stock is so badly faring in the market. Otherwise, you tend to get an investor who is willing to purchase your share. So then in case of private, yes, private selling of shares is not so easy since there is no stock in the exchange, and finding a new shareholder can be very hard and time consuming. So when it comes to monitoring, the public companies are monitored by the stock exchange, and there always a very high level of protection for the shareholders, regardless of their stake in the company. When it comes to private equity, the shareholders have to protect themselves and values generated by the company, and all the rules will be stated in a formal agreement. These are the differences. I think I find some, there may be a chance that there may be a question from this side. This matrix, 2 by 3 matrix. So next is valuation gap. I think whatever the difference between the value or rather the investment entrepreneur is seeking and the amount which is not being agreed to by the investor. So this is the, say if there is a 4 million worth of valuation, pre-money valuation, out of which angel investor agreed to invest 3 million, whereas for the 1 million they didn't agree to it. So how will they bridge the gap? There are so many ways in which they can. One is by the issue of warrants or liquidity preferences or dividends at a higher rate or preference shares, which can be either convertible or redeemable. So when it comes to IPO, like once the company from the private equity investment, it goes to the public route, it has to go through IPO. IPOs, there are basically three types, like cash in IPO or cash out IPO or offer for sale. These are the three. And then the fourth one is distribution of shares to the existing shareholders. This is basically a rights issue. So these are the ways in which a company can go public or issue the equity in the public. So basically, cost of new issues is very expensive. It depends on the size of that particular company, like a particular IPO. If larger the IPO, lesser the cost. It starts from, initially when you go for funding for less amount of money, naturally it may go up to 55%. This figure is basically of US exchanges. So maybe in the Indian context may vary, but usually between 10 to 55% of the offer value. Say if you somebody in the market, like, they can throw in some idea about this particular issue, like whether what is the actual costing in Indian setup. Falguni, can you?
Yeah, the actual costing can vary from 10% to 55% based on how much capital you want to list. So
Yeah.
the professor has given a chart that this cost is varying from 55% to, if you are raising a very high capital, then it will be 10%. So
That is,
lower the, so you have to remember the conceptually that lower the amount that you want to go for IPO, your valuation lower, your percentage will be higher. And higher the amount that you want to raise, it will be the lower, the cost will be lower.
right, right.
It varies from
So
10% to 55%.
absolutely. So where do that cost? Where are these cost spread into? One is cross spread, underwriting discount. The other is other direct expenses, indirect expenses, and underpricing. These are the four areas where the entire amount or the costing comes into. And then
Underpricing is not the component of expense. It could be like because your shares or the value is underpricing, so that's why you need not to get the
that
full
is
value
again a
of
cost,
it.
right? Cost to the company.
So discount is a cost, you are saying, right?
Yeah.
Suresh bhai, can you quickly explain what is a up round and a down round?
Maybe
Basically, the value
I
in
feel
increase.
valuation.
Up round is based on the valuation, down round is again based on the valuation. Post that round of investment, if the value goes up, it's called up round, and if the overall valuation comes down, it's called down round.
So up round and down round is only with respect to the previous round, the immediate previous.
Correct.
Right. So let's say if something if there's a valuation of 5 million in the next round, if it becomes 7, then it's up round, and then immediately after the 7 it goes down to 6. That's called a down round, right?
Down round.
Absolutely.
So basically it is with respect to the immediate previous round, right?
Absolutely. I think he gave an example of Zomato, na? Zomato
also.
Yes, Zomato.
It went up, and later there was a steep fall in the prices and the valuation. So that is what he was sharing that. Okay, now when it comes to fundamental analysis, what do basically you do? It's basically a firm's intrinsic value that comes from its earnings prospect, which is determined by one, the global and domestic environment, and then the second is economic factors affecting the firm's industry and the position of firm within its industry. These are the three variables. At larger picture, it is the globe or the domestic market. The other is within the industry, and then within that industry, the position of that particular firm. These are the three things which which determine the intrinsic value of that particular company. Right? Is that okay?
So we should not look into
crash course में पूछने के नहीं जाते रह
Okay, chalo. Now, in case of global economy, there are three factors which we have discussed. So, in case of global economy, what determines? Like it is harder for businesses to succeed in a contracting economy than expanding one. So, if there is a growth, naturally the valuations increase. When there is a a recession, naturally it will be depressed. And it all depends on performance countries and regions, which can highly vary. There are a lot of political risk, like the recent risk with Russia-Ukraine war, which took the entire companies to a toss. So it all depends, like within that also, how much it affects a particular zone. Like the amount it affected Europe will be in case of Latin America or Asia, it may be lesser. So it depends on the region. Then there is something called as a political and financial stability, exchange rate risk. These are the risks, that will determine the valuation of your company and how much you are glued to, or basically you are hooked to the global economies. If you are totally into domestic market, then the dynamics keep changing. When it comes to domestic macroeconomy, it is basically to forecast the broad performance of the market. And second is the stock prices rise with higher earning prospect and PE ratios, which should be generally in between 12 to 25. So this gives you a fair amount of idea about the valuation or the so-called fundamental analysis. And in global domestic macroeconomic economy, what are the key variables? First one is in any case GDP, then the consumer sector, especially non-durable items, like how much of consumption in case of FMCGs or whatever the daily necessities other than durables. Durables have different cycles altogether. So then the investment spending, how much, whether it is home loan applications or inventory positions. Then the spending by the government sector and into which sector. Both are very relevant. And then comes is the net exports and your inflation figures, crude oil prices, food prices, CPI, unemployment rates, in the index of industry production, capacity utilization. These are the areas. I think there is some issue with my. No, it's not. Can somebody, present this particular PPT so that there is no such problem?
Your scroll was not working, is it?
Yeah, my scroll is not working, and then there is a problem. Should we continue or should we stop and do it tomorrow?
I think do it tomorrow. I am already sleeping.
Cholo, let's call it a day.
I think Suresh bhai can continue till 11.
Till 11? Can somebody share it, or should I do it again? In any case, there is some problem.
What is that? What do you want to share?
अभी जो मैंने जो notes है ना, notes, if you can share it so that.
Actually, I want to ask one question. In professor's notes, na the PPT, there is one valuation के ऊपर है कि suppose negotiation on valuation, how to bridge the gap. So उसमें उसने एक illustration दिया है कि you can have 5% warrant also you can issue, which can be converted to equity after 10 years. 5% warrant. So उसमें प्रोफेसर ने बोला है कि you are investing right now out of 4 million valuation, you are investing 1 million. So you are 25% owner, and then 5% warrant is issued, which you can convert 10 years. So he's saying after 10 years you will be 1 million valuation. Again you will be getting 1 million shares. So वो मुझे समझा नहीं, because 5% of the warrant, I was calculating 5% of. We have to calculate 5% of. उसका कुछ इंटरेस्ट भी था ना, 5% इंटरेस्ट कैलकुलेट करना है for 10 years.
Falguni, I read, I gone through that recording. Even that time also, professor just avoid that answer and he just moved out from that question and said, "Okay, we will not." I think something like that. He said, "Okay, we just stop here and we start move ahead because there is no clear answer at that time even." So I think
अच्छा
we all have any very limited time to complete all the things, so we can continue because it is very small thing how the warrant calculate because it is part of valuation gap. It is an instrument of valuation gap. That's it. That's the answer of the question at present.
So, so
Even even
Falguni,
even
it's a
otherwise,
1 million exchange, right? So the
नहीं नहीं
investor
$1 million
agreed
कैसा
to
है
spend.
वो बाद में अलग से मुझे जरा बता देना बिकॉज मुझे
But if we
1.25
continue
आया
on this topic, it will not end, and we will
नहीं
stop.
अभी
People
नहीं
are
अभी
raised.
डिसाइड करने का नहीं है मैं बोली खाली मेरे को 1.25 आया कोई बात नहीं चलो आगे बढ़ते हैं मुझे
say
लगा किसी
there
ने
is.
किया है तो क्विकली बता सकता है
I have an answer for that. See, if that be the practical situation, you can hire an expert. He will explain you.
मतलब
चलो
कुछ भी बोल रहा है
Very good answer.
सुरेश चलो आगे बढ़ो.
कंसल्टेंट को काम दो बोल रहा है वाह
बस और क्या चला. Anyway, मार्केट में बहुत सारे लोग हैं
फेवरेट है
स्पेशल.
कंसल्टेंट्स
Pardon me?
नहीं आगे बढ़ते हैं
Chalo. Business cycles basically actually see there are 2-3 more factors also which in continuation of the previous one, unemployment rates, index of industrial production, capacity utilization rate, and interest rates. These are the things, broad parameters which will decide the performance of domestic market. That determines the price of your company or intrinsic value of the company. So then there are business cycles which I need not explain it any further. It is basically peaks and troughs. So peak is basically at the highest point where the it has reached the peak, whereby the next will be the fall. So that is where the capacity has expanded beyond the demand. So there will be huge there will be a slump of demand. At the same time, a lot of you can stockpile of inventories. So because of that, the so-called supply will be reduced. So till this entire of the thing, and once the supply is reduced, naturally, what will be the next? The next consequence will be laying off certain people because there is a lot of surpluses to be sold. So there will be lesser demand, and then the so-called monetary and fiscal policy will come into picture, and they will try to act in such a way that the what do you call the so-called your interest rates will fall, so that the people will start investing, and then the cycle continues. So then next is cyclical industries. There are two kind of industries: cyclical and defensive. Cyclical industries are cyclical in nature, like your consumer durables, capital goods, and they have very high beta. I think today there was a quiz, like I think I don't know who has put it. If I remember, it is Manish Srivastava. So then there are defensive industries which are not at all sensitive to any business cycle. They have continuous demand for the goods and services, like especially food producers, processors, pharmaceutical industries, and public utilities. They basically have low betas. So for today, I think we can stop it with this, or should we with this interest rate cycle? After that, we will discontinue. Tomorrow, we can continue with the session 5.
Yeah, I think that's a good idea, Suresh bhai.
Yeah. So, interest rate cycle, short-term rates are likely to decline during a recession as the demand for credit softens. Central banks tend to promote more accommodative monetary stance to ensure economic recovery, which I was discussing. Then the credit spread widens during a recession. Just remember this particular thing. So they may ask, what are the true or false kind of a statements, or identify the odd ones out, kind of a question. So then the short term rates move with the cycling economic cycle with lag or lead of 2 months. So there is a lag or lead of 2 months in case of short term interest rates.
So these are the things which you just try to memorize and try to understand it. Probably this can be a question. So for tomorrow, we will put it off like commodities, currencies, and derivatives. Some experts in this can continue with it.
Suresh bhai, on page number 9, you use term high beta, low beta. What does that mean?
Pardon me?
On page number 9.
ये cyclical and defensive industries में high
high betas, low betas.
Vipin, so basically high betas are the sensitivity
Beta is
towards the
basic-
market movement, right?
Absolutely.
So let's say
Absolutely.
your stock is going at the Sensex, right? For example, it's moving by 1%. So let's say your beta is 1. That means it's a perfectly correlated. So that means it will go based on your Sensex, upward or downward. Similarly, and then there is low beta means again it will go in the same direction, but the volatility will be little less.
Understood. Thanks.
If Sensex grow by say 1%, they may grow maybe 0.5% or even less, or less than 1%. That is low beta. Yeah.
Remember ITC only.
Yes.
Yeah.
Correct.
Surajji, on page number 24, the beta formula is incorrect. So it's a.
No, beta is basically a standard deviation.
No, the formula which in the note is incorrect. So someone is referring then.
He has given that variance, covariance kind of a thing. Market, how much there is a variance and covariance.
It should be covariance upon variance.
Yeah. So.
Suresh
in
bhai,
any case, yeah.
Since it's a relative marking, so if we all can decide that nobody is going to cross, 50%, then we all will get through in line.
अरे मनीष,
Who said it is relative marking?
अरे मनीष भाई, आप सोशलिस्ट इकोनॉमी